And first and foremost, I just want to say, greetings to everybody, and glad you're at the FXCM Expo. I'm especially glad you're in this particular session and any other sessions that you might have attended as well. Good to see all the familiar faces from other sessions. Good to have people introduce themselves to me who I've only known by names on a webinar or email addresses or something like that. It's nice to be able to attach a face along with that moniker that I see in the webinars, as well as in the emails that you occasionally send in with questions. So glad you're all here. My name's Richard Crevo. I'm one of the trading instructors, Daily FX, and I will do my best to explain three simple trading strategies to you. Now, those of you who have been in any of the sessions here, I know my sessions, I can speak for those, you've probably seen these risk disclaimers. And I know when I first started trading, I would see these risk disclaimers all over the place. And I wouldn't ignore them, but frankly, I got tired of seeing them out there. It's like, enough. But as I've said in all my other sessions, and I'm going to continue to repeat in here, ignore these at your own peril. Because as it says right here, trading foreign exchange on margin carries a high level of risk, may not be suitable for all investors. That's absolutely true. So, forewarned and all that type of thing. Don't want to discourage you, but I do want you to be aware of that situation is very much a part of this particular market. And I always add my own caveat to this with the phrase risk capital. You should only be trading with what you can define as risk capital, and risk capital is money that you can afford to lose, because you will have losing trades. Make no mistake about it. Everybody, the best traders in the world have losing trades. You're going to have them too. I'm going to have them too. And you just only want to be trading with money that if you lose that money, your lifestyle is not going to be affected one tiny little bit. Because number one, if you're trading with money that you cannot afford to lose, you're not doing yourself any service financially. You're being, in my interpretation, kind of playing fast and loose with money that you shouldn't be playing fast and loose with. And you're putting extra pressure on yourself. My colleague Matt Russell in the other room was talking about trading psychology, treating trading like a business. He's going to be talking about trading psychology later this afternoon. And if you're putting more emotional stress on yourself by trading with money that, oh my gosh, if I lose on this trade, I don't make next month's mortgage payment, or maybe my kid doesn't go to college or something like that, you got enough stress trading, especially if you're new at it. Don't put extra stress on yourself by trading with money that, oh my gosh, I can't lose this, because you are going to have losing trades. Okay, pay attention to the risk disclaimers. They're all there for a reason. Okay, the objective of this session, excuse me, is to provide you with three simple trading strategies. The chart setups are very straightforward. The entry and the exit plans are clear. If they're not, feel free to ask the questions. Trading, in my opinion, is as simple or as complex as you make it. It's tough in the beginning. It's not an easy way to go, but once you get an understanding of what's going on with the markets and you have a strategy under your belt, it is simple. That doesn't mean it's easy. It's simple to understand, but it's not an easy way to go. Or you can make it very complex. And new traders, well, not only traders, but anything new seems really complex. I can't remember back to when I first started to learn how to walk. I'm not going back. I can't remember back that far. I'm sure it was pretty complex for me at the time to kind of figure out how to do this and maintain my balance without falling over. I can remember a little bit about learning how to ride a bike. That was kind of tricky too, but I mastered it. Driving a car, whatever it is. It's tricky in the beginning. And in the beginning with anything, we don't know what's important, so we focus on everything, which tends to make it complex. And new traders especially focus on the complexity of something. Whereas professional traders, they've kind of gone through the process, they know what's the complex part, and they get the basics under their belt, and then they know exactly how to compartmentalize things and move forward. And that's kind of what we're going to look at here today on these three simple strategies. This is a chart that was actually sent into one of us by a newer trader. And this is what I mean about focusing on everything. One of the questions that was had was, how do I figure out where the price action is on this particular chart? Well, it's up here. The candlesticks are up here. And on this particular charting package, there's the price that the currency pair was trading at. right at that point. But this gent had everything imaginable. I mean, there's a few things that he probably didn't have on that chart, but I mean, I had to look at this thing for 10 minutes, and I've been doing this for a lot of years, you know, to kind of figure out what all he had on here and what it was telling him. So as a newer trader, my number one rule is don't clutter up your charts. And this is, like, again, my example of new traders tend to make things more complex than they have to. Simplify your charts, clears your mind a little bit. You don't have to be paying attention to all of this stuff. The three simple trading strategies that we're going to be focusing on are news fade, inside day candle breakout, and the 2-hour MACD crossover. Okay, the news fade strategy. When a news announcement comes out, especially if it's a real high impact kind of announcement, there tends to be more volatility in the market. There's a lot of reaction to that. It can kind of be kind of a knee-jerk reaction because you're dealing with two things. A lot of people at the webinars, they'll send in questions about, well, if, let's say the NFP announcement, which we're going to talk about, non-farm payroll, if that announcement comes out and it's good for the US dollar, what's the reaction going to be in the market? Well, number one, I don't know. Any of you who have attended my sessions know that. You don't know. There's no crystal ball. But you're not only dealing with the NFP number that comes out, you're dealing with the reaction to the number. How many people in here have maybe given a gift to somebody, and in their mind, they pictured what the reaction of that person was going to be when they received the gift, and then the reaction that you got from the individual was not quite what you expected when they received the gift? I know I've done that in certain situations. I expect, oh my gosh, you know, you give somebody a gift, they're going to just be over the top, and it's kind of like, oh, hey, that's pretty great, thanks. What are we having for dinner? And, you know, they're on to something else. And it's the same thing with the market. You're not only dealing with the number. Once the number comes out, it's good or bad, but it's the market's reaction to that number. So you're dealing with two complete variables, which makes a news event a little bit trickier to trade. Now, as far as knowing when these news events are going to come out, what you want to do is you want to go to www.dailyfx.com/calendar, economic calendar. And this is going to give you, for the week, all of the news events, all the financial announcements that are going to come out. Now, what I do is, if you'll notice over here, where it says importance, I filter it down just to the high-impact announcements. Because if I'm going to trade a news fade strategy or a news strategy, I want the announcements to come out that are going to cause some volatility in the market, because that's what I want to be trading in that situation. So you can do that by, when you go to the calendar of events, you see that filter button right up there? Just drop that down and just de-click everything or uncheck everything except high. And this simplifies it. It brings it down to, again, a more manageable number of events that you can check out. And then you know, okay, if I'm trading the British pound, one of the British pound pairs, in this situation, this calendar obviously is dated, but July 26th, back a couple months there, I know that I want to be paying attention to this announcement as it comes out at 8:30 on Tuesday, June 26th, if I want to, or July 26th, if I want to trade that event. And so you can just go down there and you can either make a notation on a legal pad, on, you know, whatever you want to do, an Excel spreadsheet. So I want to be paying attention to these events, and this is the way you can get it. I go to this calendar at the beginning of every week, so I know what's coming out that might impact the pairs that I'm trading. Now, with the news fade strategy, does everybody know what fading a move is? Okay. Fading means going the opposite direction of a move, and we're going to have some charts that'll show you that. But if the initial move was like this, fading the move is going to be going like that. If the initial move was to the upside, fading it is going to be going down. If the initial move was to the downside, you fade a downside move, you're going to be going up. You're going to be buying it. So one of the things about the news fade strategy is little patience and discipline. You don't have to be patient too long. You got to be patient for about 15 minutes. So it's not anything where, oh my gosh, I got to wait months. But wait about 15 to 20 minutes after the news release to see if the market begins to reverse. And sometimes it's going to happen, sometimes it's not. Like with any strategy, it's not going to work all the time. And you could be sitting there and you could be waiting and you go, man, I've been waiting for this news release. Well, the NFP comes out once a month. I've been waiting for the news release for the NFP for a month, and what do I get? Nothing. It's part of the trading game. Next month is coming too. So you can trade the NFP next month. It's not going to happen all the time. There's two ways on news fade. One is an aggressive approach, and that's at the open of the fourth candle. I'll show you charts on this. It sounds a little more tricky here than it is once you see the charts. At the open of the fourth candle, enter and place a stop above the previous high or low on the premise that the market will revert to previous levels. The more conservative approach is if and when the market trades through the level at which it was trading before the announcement, a trader can enter a trade in that direction. Let's talk briefly about non-farm payroll before we look at a chart. Everybody familiar with non-farm payroll announcements? And it's certainly okay if you're not. What I'm going to do is I didn't get a lot of hands. Non-farm payroll, the NFP, as it's popularly known, has kind of taken on a life of its own over the last several years. It is the single most volatility-inducing event in the currency trading world on a monthly basis. There's more volatility around that announcement, generally on a regular basis, than there is any other news announcement. And what it does, it's a number that's put out by the Department of Labor, and it measures the number of jobs that were added to the economy during the prior month in all areas except agriculture. And the reason they kind of pair out the agricultural jobs is because a lot of the agricultural jobs tend to be more temporary in nature. And maybe there's somebody that's gathering crops for 3 months in a certain part of the country. So that's not going to be a job that's going to go on for a full 12 months, so it's not going to have as great an impact overall on the economy as somebody that's get hired for a job and they're going to have that job for 12 months or 10 years or whatever it might be. So that's why they filter out the agricultural component. And the NFP is released on the first Friday of every month at 8:30 a.m. Eastern Standard Time by the Department of Labor. And people wait for that number. If any of you have watched like CNBC or Bloomberg or anything like that, I mean, they have a countdown, incoming news, 27 minutes to NFP, NFP in 2 minutes, something like that. It's a big deal when that number comes out. Okay, here's two charts that are somewhat hypothetical in nature, but this is what we're looking for. And what you do, you can see this is a 5-minute chart that we're having here. And right here, we've got the component, a little smidgen of a 5-minute chart here. And this is the candle that we're concentrating on because this, at the bottom of the candle here, is where the Euro-USD currency pair was trading right there where my cursor, or where my little dot is there, prior to the announcement. And then this 5-minute candle, we get this spike up. So the news fade strategy, we wait 15 minutes or 3 5-minute candles, and then we fade the move. So this was the move to the upside, 5, 10, 15, 3 candles. At the open of the fourth candle, we fade the move in the opposite direction. So this is the correction right here. So at the open of the fourth candle, we'd go short the Euro-USD, and our stop would go above the highest point to which the pair moved after the announcement. If it moved the opposite direction, and I'll have a chart showing that, then the stop would go below and we'd go long the pair. But in this situation, the market reacted to the upside. We wait 15 minutes or 3 5-minute candles. At the open of the fourth candle, we go in the opposite direction of the initial move. That's fading the move. Excuse me. And here's on the other chart showing that's the candle where it opened, and this is the candle where we enter the trade at the open of this candle short, and we set our stop right there. Now, that's the aggressive way to trade it. The less aggressive, the more conservative way to trade it is to, again, we wait for the open to occur, and then we don't get in based on the fourth candle, but rather we wait till the price action gets below or right at the level that the market was trading just prior to the announcement. So what we'd be looking at on the more conservative approach is when and if price action trades down to the point at which the market was trading prior to the announcement, we then enter short at that point with our stop up here. So you've got more at risk in the conservative strategy, but because the pair traded back down to the level that it was trading at before the announcement, there is the potential for more follow-through if the chart would be going down, that far. So like I say, it's a trade-off. If you're a more aggressive person, get in on the open of the fourth candle, place your stop up here. If you're a more conservative person, wait until price action reverts or trades to the level it was trading prior to the announcement, and then you can short at that point with your stop in the same place. Here's two other announcements. This is from the UK, CPI, Consumer Price Index release. And here's the same concept again, 5-minute candle. This is where price was trading right there when the announcement came out. 1, 2, 3. We fade the original move at the open of the fourth candle. And here's German GDP, gross domestic product. In this instance, it moved down dramatically when the announcement came out. So this is the move we want to fade. So it moved down 1, 2, 3, the open of the fourth candle. In this instance, we'd go long. Now, I've got 3 perfect charts here. Okay, this is not going to be replicated all the time in real life. You know, well, Richard showed me 3 times where this worked, so therefore, you know, every time I do this, it should work. These are the examples of what you're looking for, the ideal situation. It's not, I guarantee you, going to work all the time. This is the premise that you're looking for. This is the concept. So timing is the critical component of the news fade strategy. Again, wait 15 minutes before entering a trade. And this will be at the open of the fourth 5-minute candle after the news release comes out. And then at the open of the fourth candle, we'll trade in the opposite direction, fade the move of the most recent price action. And this is based on the anticipation that price will revert to previous levels that the pair was trading at prior to the news release. And then set your profit target at the levels the pair traded prior to the news announcement and or at a 1-to-2 risk-reward ratio. And then set the stop just outside of the most recent high-low after the news event took place. Now, before the question comes up, because in here it came up in some other classes, the idea that, let's say the Swiss National Bank, a couple people, when the Swiss National Bank intervened, and instead of the Swiss franc getting strong, it got weaker, all of a sudden somebody said, I didn't see anything about that on the calendar of events. Well, yeah, it's supposed to be a surprise. Interventions, they don't want to let you know. They want to catch you leaning the wrong way, so the Swiss National Bank, in this case, gets the most bang for their buck, their intervention buck. They're not, you know, it's kind of like you putting a sign in front of your house and saying, you know, out there to the world and to any burglars that might be out there, I'm going to be gone the week of such and such through such and such, and the key is under the 3rd rock from the door to the right. Why would you do that? You know, you got nothing to gain by doing that. And the Swiss National Bank has nothing to gain by saying, hey, at 1 a.m. on such and such a date, we're going to intervene and just watch that Swiss franc move. They're not going to do it. So they can do what they want to. It's their money. It's their francs. Just like you can do what you want to with your money, they can do what they want to with theirs. They wanted to intervene and keep the Swiss franc from getting any stronger. So they did. And this is the same situation that you would have on a calendar of events, in that you're not going to have announcements like that on there. But for all intents and purposes, every scheduled news announcement, financial announcement that comes out is going to be on that calendar of events on a regular basis. And this is another hypothetical type of chart, so you can kind of graphically picture how this works. Okay, so here's where the announcement happened. Again, 1, 1, 2, 3. And then we fade the initial move, so we'd be selling right there. And this is a good graphic example of a 1-to-2 risk-reward ratio. Notice how the distance between our stop here is about half the distance of our profit target. So we're risking this amount of loss for potentially this amount of gain, putting it in a graphic sense as far as the news fade. And I'll put this up after each one of the strategies, because then, again, I want to drive the point home that you have a strategy, and that gives you a good edge. But absolutely in no way does that mean, hey, I've got a strategy, and things are going to just be going great when I execute this strategy. It gives you an edge, but an edge doesn't mean that you're going to have winning trades every time you employ this particular strategy. So please keep in mind that using this strategy, or any other, I might add, does not guarantee profits, as market conditions can vary, and currency trading involves substantial risk. Because one NFP is going to be different from every other NFP. You can't say, well, because the economy added 110,000 jobs 6 months ago, if it adds 110,000 jobs this month, the same thing is going to happen. You're dealing with people. The market's made of people. And what's going on in people's heads at the time that a news announcement can come out is going to be very different from month to month to month, based on a lot of other things in the economy. All right, strategy 2, inside day candle breakout. Again, a hypothetical type of chart just to show you what we're looking for. The green candle is a closed daily candle. These are all the trades that took place in whatever this currency pair is over the course of a 24-hour period. This is, let's say, for the sake of argument, today's closed daily candle. And we can see that this daily candle closes inside of that daily candle. This daily candle, body and wick, is completely inside of the high and the low of the previous daily candle. So this is an inside day candle. It's inside the high and the low of the previous day. And like it says, strategy requirements, daily candle stays contained within inside the high and the low of the previous day's candle. That's what it looks like on this hypothetical chart. We'll show you on some real charts in a minute. So what we're looking for here is when you spot one of these inside day candles like this, the idea here, this is a breakout strategy, the idea here is that we would look to buy 1 pip above the previous day's high or sell 1 pip below the previous day's low. So you'd be setting an entry order at the high and at the low. Familiar with entry orders? Okay, entry order is, a market order is where you click your mouse and you get into the trade at the market. Whatever the market's trading at right now, bang, you're in the market, you get the best available price at the time, that's a market order. An entry order is, I decide where I want to enter the trade, and then I set an entry order at that point. So it's my decision where I want to enter the trade. Market order, I click, and then I'll get in at that point, but if I'm waiting, in this case, for price to go above this or below that wick, I'm not about to sit there for 24 hours in front of the computer, with bated breath, just, oh man, I'm here, let me click on that mouse. Set an entry order so that you can get on with your life. I mean, trading's great, but personally, and I love trading, and I've been doing it a long time, I don't want to sit in front of the computer 12, 18, 24 hours a day. I mean, it's not good for you mentally, it's not good for you physically. It'll make you nuts, and that doesn't help you with your trading at all. So you want to set entry orders in this particular situation above and below. And what you can do on FXCM Trading Station 2 platform as well is you can set OCO orders, one cancels other. So if this triggers to the upside, I don't want this sell order hanging out here because I could forget about it, and I don't want it. So you can set an OCO order, and when this triggers to the upside, it automatically cancels the other order that you have down here to sell it. And if you want to learn more about doing that, you can go down in the expo hall there and go to the Trading Station 2 booth, and they can show you live how to set an OCO order. It's first time through, you might go, what, like that? But after you do it a few times, it just becomes second nature. This is a setup you're not going to see too often, but if you do see it, it's pretty compelling. First day, we've got an inside day candle here. This candle is an inside day candle to that one and to that one. This is an inside day candle to that one, and that one. If you see that type of setup, again, not a guarantee, but that's pretty compelling when you see that. Now, those of you who are familiar with chart reading and trend lines and things like that, what we're seeing developing here is like a triangle pattern. See how resistance is moving down if I would connect those upper wicks, and support is moving up if I would connect those lower wicks. So essentially what's happening is price action is coiling up like a spring. And you know what happens, if I just had a nice spring up here and I started to push it together, at some point that baby's going to go. And at some point this is going to go too. So what you would do is you'd still use, technically you could use any one of these, but these breakouts are going to be pretty small. Like if you set a buy here and a buy there, you'd get in, and if you got a buy position, potentially you get the difference from there when it breaks out, the difference from here to here. Personally, what I would do, being the conservative trader that I am, is I'd still be setting my entries at the top of top and bottom of that particular wick there. But this is a stronger signal. When multiple candles stay within the high and the low of the previous day's candle, the strategy becomes more reliable when these multiple inside day candles stay within the high and the low of their respective previous day's candles. Here's a couple on a chart. And there's some others on here, but here we go. So this is the first candle that closed, and this is a daily chart. And this candle closed wick, top and bottom, body, top and bottom, inside the previous day's candle. So this is the blue one here, is our inside day candle. It broke out to the upside. See, that's 1 pip above. So at this point, we'd be entered into the trade, and we'd place our stop below that wick. And you can see this worked out quite handsomely. That's going to happen sometimes. That's not going to happen sometimes. But this is the setup that you're looking for. Notice, too, that the trend on this daily chart of the pound USD is to the upside. So me, again, being the conservative trader, I would be looking for the breakouts to the upside here simply because that's more in the direction of the trend. If you don't want to be quite that conservative, you can do it exactly the way we said and set entry orders on either side of that candle. Okay, here's another one where we've got daily chart on the CAD Swiss, and here's our closed candle. Here's our inside day candle. We place an entry order above and an entry order below those wicks. It happens that right here where it took out that upper wick right there, this is where we'd be in the trade. And you can see it took it out and then it retraced, but our stop is way down here, so we're still in the trade. And this is a good example of, again, why when you get in a trade, you want to leave some distance between your stop and your entry, because you want to allow the pair time for that trade to mature a little bit. If you got your stop right on top of your entry, it's more likely than not you're going to get stopped out. So you want to give the pair some room to breathe. Three things to keep in mind about the inside day strategy. It does not set up all that often. I mean, you might see on a daily chart, you might see it maybe 2 or 3 times over the course of a couple weeks. So once you get your eye kind of tuned to looking for that, then they'll kind of jump out at you. But it's not something where, okay, which inside day breakout candle should I trade today? There may be a few, there may be none. Just depends. The example that I use, if you listen to my webinars, and I had a couple of slides showing car accidents. I'm driving to work and I'm paying attention. I'm doing everything right behind the wheel. I'm slowing down. I'm observing all speed limits, everything. Everything is perfect when I'm driving to work. Could I have an accident? Sure. May not be my fault, but some guy coming across an intersection didn't see the light change, and I get T-boned in that situation. I didn't do anything wrong, but hey, I'm still in an accident. It's the same thing here. I can do everything right and still have a losing trade. And I know that's very disconcerting to a lot of newer traders, but that's the trading game, which is why you have to use good money management, because you will have those losing trades. And when you do have them, you don't want to lose more than 5% of your account. That's what we teach anyway. And I know a lot of traders, they'll lever up their accounts, and they'll risk 40, 50, 60, 70% of their account at a time, and then they have a losing trade. And their account goes, from $1,000 to $300 in like that. And they go, what happened? Now, that was your fault because you risked way too much, of your trading account. It's better on a daily chart. You could use it. You could have an inside 4-hour breakout. You could have an inside candle 1-hour breakout. But keep in mind that every time you go down a time frame, you're compromising the integrity, if you will, of the information that you're getting. Because, and some of you might be familiar with this already, but with a daily chart, like in that candle right there, that candle has the data from every trade that was made on the CAD Swiss pair in a 24-hour period, from 5 p.m. Eastern one time, or one day until 5 p.m. Eastern the next day. That's 24 hours worth of trading data in there. That's a lot of data in that one candle. Now, if you go down to, and you use it on a 4-hour chart, each candle in a 4-hour chart has 1/6, 6 times 4 is 24, 1/6 the amount of data. So if I'm basing a decision on 1/6 the amount of data, chances are my decision, my trading decision, is not going to be as grounded in reality as on a daily chart. If I move down to a 1-hour chart, now I'm dealing with 1/24 the amount of data. So the charts aren't giving you false information. They're just giving you information based on less data. And just think of yourself in life. If you've got a major decision to make and you ask one of your friends, and maybe this can be a great friend who's very knowledgeable and knows you really well, you ask one friend for feedback on, should I change jobs? Should I go to college or not go to college? If I go to college, what should I major in? That type of stuff. Should I buy a house? Should I not buy a house? You ask one person. You got one piece of data. What if I ask 6 of my friends for feedback? Chances are I'm going to get some more perspectives, and I'll probably be able to make a little better decision, based on that. It's the same way with the charts. So if you go to a weekly chart for an inside weekly breakout, that's going to be even more valid, but you're going to have less trading opportunities. Okay, strategy 3, 2-hour MACD crossover. This one's a little more involved, we'll have to think about it a little bit more, but still very straightforward and very understandable once you do it a couple times. Strategy 3. You buy when price action is above the 200 period moving average. This is on a 2-hour chart, obviously. Price action is above the 200 period simple moving average and the MACD line crosses above the signal line. Sell when price action is below the 200 simple period moving average and the MACD line crosses below the signal line. We would close the position when the MACD line crosses the signal line in the opposite direction of our entry. Okay, that words. A picture is worth 1,000 words, so let's have a picture of a chart up here. This is a trending strategy again, so it works best in a trending market. And I like to use it personally with pairs that have a little more volatility associated with them, so we get a little bit of oomph, behind the move. And generally, any of the pound pairs have more volatility associated with them than do some of the others. So here we've got a 2-hour chart, and we've got our 200 period simple moving average, that green line. And what that is comprised of is, like right here, where my cursor is on this 200 period moving average, how that price is arrived at right there is we'd add up the previous 200 2-hour candles, the closing prices of the previous 200 2-hour candles, add them all up, divide that by 200, and we would get that price right there, or that price right there, or that price right there. That's the 200 period moving average. The significance of it is that when price is above that 200 period moving average and pulling away like it is here, momentum to the upside is increasing. We're getting more push to the upside. So we want to be observant on that. And then also, here's the MACD. MACD stands for Moving Average Convergence Divergence, popular indicator. It's made up of 2 moving averages, and the MACD line is the red line right here, and the blue line is called the signal line. And you've got 2 moving averages. And in an uptrend, what we want to do is our buying signal is going to be triggered when the MACD line, the red one, crosses above the signal line. That shows bullish momentum, upside momentum, is pushing this pair to the upside. Price action is above the 200 period moving average. And here we've got the MACD line crossing above the signal line, right where that arrow is. And so we would enter right there. We'd buy at this level, which happened to be 1.6190. And we'd stay in the trade until the MACD line crosses the signal line in the opposite direction, which signifies, based on the MACD, that, okay, bullish momentum is no longer in favor. The pair is now moving to the downside. So we'd enter here at 1.6190. MACD crosses over to the downside. We get out of the position at 1.6280. And in this situation, where I would have placed my stop is right below that wick right there. I love to see those long wicks, because I mean they're great for stop placement. Here's another in a downtrend. So we know it's a downtrend. Number one, we can see it's moving from left to right. The slope of our line that we would draw there is to the downside. Price action is below the 200 period moving average. and the MACD line crosses over the signal line right there to the downside, so we would enter at that point right there, which happened to be 1.6150. My stop would have been up here. And then we would get out of the trade when the MACD line crosses over the signal line in the opposite direction, showing that bearish momentum is no longer in favor, and now momentum has changed to the upside. And in essence, that's the 2-hour MACD crossover. Like I say, a little bit more to maybe, wrap your head around, but if you do this a few times, you can, kind of get the feel for it pretty readily. What I encourage people to do with these strategies, in fact, that's kind of going to be a little bit in the, the wrap-up here. No strategy is perfect or will work every time. I said that quite a bit, and I want to definitely drive that point home. And then test strategies in a demo account to be sure that you are comfortable with them. And don't fall into the trap of, I know as newer traders, and I don't know how long anybody's been trading in here. Some of you might have been trading for 10 years, some of you might have been trading for 10 minutes. I don't know. But newer traders, you're anxious, and I can appreciate that because I was a newer trader too at one point. And I want to trade. Test strategies in a demo account lots of times. What traders fall prey to sometimes is, okay, I tried it, get back home Monday or tonight or whatever it is, and I try it, man, this works. Bang, you're trading real money with this strategy after one test. No, it may work one time. That doesn't mean it's going to work again for an extended period of time. You may have 10 losing trades in a row. That doesn't mean it's a bad strategy. That just means it didn't work 10 times in a row. What I'm talking about is, and I know this will put some of you off, I'm talking about at least 50, better yet maybe 100, 125 times in a demo account so that you just can do this blindfolded. Like in the military where they teach you how to assemble and disassemble your rifle blindfolded and on your back and upside down and hanging from a tree and everything like that. You just want to be able to understand this stuff so it's second nature. Same thing here. I mean, think about it. It's your money. I guess if you want to play fast and loose, you can, but demo, 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 demo. And I know demo trading is not the same as live trading, but still, get the feel of it in a demo account and then step into, with any new strategy, slowly trading it small in a live account and then slowly ratchet up your position size, if you want to, as you become more and more comfortable with the strategy. Okay. Well, I definitely thank you for attending 3 Simple Trading Strategies. Thanks for your attendance. I appreciate it. Okay. Very good. Thank you.